Have you noticed how the smartest people in your circle, engineers, doctors, researchers, can solve impossible problems, yet freeze when the market dips 2%? Today we'll uncover why hyper-analytical minds struggle with investing and how to fix it. It's not about IQ, it's about behavior. The genius trap. In the lab or a codebase, precision wins. In markets, uncertainty wins. That mismatch is why even geniuses stumble. And by the way, that famous line Einstein called compound interest the eighth wonder? Likely misattributed. But the lesson still holds. The myth shows how even smart people love neat stories more than messy evidence. Scientific thinking trains you to eliminate noise, demand exact proofs, and optimize. Investing rewards you for tolerating noise, acting on base rates, and staying humble. Let's break this down into 5 science mind habits that backfire in markets, and 5 fixes. First, overconfidence over trading. Smart people think, I see patterns others miss. Result: more trades, more brokerages and taxes, and lower returns. One famous study of real brokerage accounts found that individual investors underperformed by about 3.7% per year, mostly from trading costs. Another showed men traded 45% more than women and earned 2.65% less per year after costs. Takeaway: too many decisions is the enemy. Fewer, better, calmer. To fix this, automate your contributions. You can use a simple rule like buy monthly, rebalance annually. Second, need for precision market timing. Scientists want exact entry points and perfect signals. But even professional stock pickers struggle to beat the broad market over time. In developed markets, more than 80% of active equity funds underperformed their benchmarks over 10 years. Takeaway: if the pros find it hard, buying individual stocks and hoping to beat the pros at their game is not a great idea. To fix this, we suggest you invest through mutual funds instead of individual stocks, as per your risk appetite and financial goals. Third, frequent checking leads to myopic loss aversion. Check your portfolio daily and you'll see lots of tiny losses. Each one hurts twice as much as a similar gain. Experiments show that when people see portfolios more often, they are prone to take more decisions which are counterproductive to a long-term investment strategy. To fix this, reduce the zoom. Check monthly or quarterly, not daily. Decide evaluation dates in advance. Fourth, theory worship leads to the disposition effect. We love clean theories like mean reversion, so we sell winners early and hold losers too long. A robust bias called the disposition effect. It feels logical. We assume it'll bounce back, but historically this behavior hurts after tax returns. Elegant stories can be expensive. To fix this, pre-commit to rules. Harvest losses by rule, let winners run by rule, and rebalance by rule. Fifth, overfitting leads to missing the real outliers. Smart minds can explain every wiggle in a chart. But wealth creation in markets is wildly concentrated. Over many decades, roughly 4% of stocks created all the net gains above government bonds. Miss a few outliers and you may end up missing the big gains. To fix this, diversify deliberately. Own the haystack so the needles are already inside your portfolio. So before we conclude, remember this investing nugget. Behavior beats brilliance. Here's your 4-rule playbook. Set the mix first. Choose an asset allocation mix between equity, debt, gold, and international investments that fits your goals and give you peaceful sleep. Automate inputs. Invest regularly through SIP and pre-scheduled rebalances. Throttle the noise. Fewer checks lead to fewer knee-jerk trades. Keep taxes low, churn low, and focus on portfolio efficiency. Einstein's real superpower wasn't stock picking, it was respect for natural laws. In markets, the laws are uncertainty, skewed winners, time in the market, and human emotion. When you accept them, you stop fighting the market and start designing around it.